So I think the most likely outcome is that the deficit will continue for the foreseeable future, but that monetary policy will have to change a little bit to eventually facilitate that. So that could be things like the Fed ending QT and going back to gradual QE. It could include changes to the SLR rules so that banks can buy more treasuries. It can include things like that. I think that, yeah, I think overall this is going to be an environment that persists for a fairly long period of time, and there are still cycles within that. So, for example, if in some ways the more like say the more that things like AI or other deflationary forces um, are impactful, they allow basically the Treasury and the Fed to kind of get away with more of this because it doesn't necessarily show up in CPI. Things that are inflating are being offset by things that are deflating.
In this analysis by finance expert Lynn Alden, the concerning state of the US deficit is brought to light. With data indicating a persistent deficit for the foreseeable future, Alden suggests that changes in monetary policy may be necessary to address the issue. However, political hurdles and the financialization of the economy pose significant challenges to implementing austerity measures. The economy's reliance on equities exacerbates the situation, as fluctuations in stock prices directly impact tax revenue and consequently, the deficit. Alden's insights underscore the urgent need for structural changes to steer the economy away from its current course. Don't forget to like, share, and subscribe for more insightful analysis, and turn on post notifications to stay updated on the latest financial trends.
On the other hand, if you have that technology and that type of thing not be as deflationary as quickly as some people think it is, or if you get other inflationary factors, like for example, higher energy prices, structurally higher energy prices, maybe it's because supply goes offline due to some sort of disruption, which these days is not out of the realm of possibility, or just general capex. If these stimulatory forces result in more energy demand over time, and there's not a lot of capex going into it, you could get another, significant energy bull market that spurs more capex eventually, and that can really pressure these types of systems. So I think that probably energy and tech deflation are the two areas to watch to see how long this current regime can last without kind of major structural changes. But I think in the next couple of years, I think the thing to watch is, does the Federal Reserve end up having to do pro-liquidity actions when they don't want to, right? That's kind of the big signpost to watch, in my opinion. I think there's two factors to that. I think that there's no political will to do austerity. So regardless of whether it could last or not, I think that just it's very unlikely. You have a very split Congress. So you have very adamant side, very strong side that would be against any sort of major tax increases. You'd have another side, in fact, both sides would really be against any sort of major spending cuts. Kind of the third rail of American politics is don't touch Social Security or Medicare, especially because that's where the majority of the voters are. Um, and so there's very little will to do that, first of all. Um, Secondarily, I think that you'd have a major issue even if you tried at this point because the economy is so financialized. And so when the economy is not financialized, equities generally should follow what the economy is doing. So if the economy is doing well, profits are good, valuations can rise a little bit, stocks should do pretty well. If the economy is weak, profits are going to be worse, valuations are going to, probably suffer somewhat, and the stocks are going to go down. But because we're so financialized, there's so much net worth stuffed into equities. And then in particular, what makes America different than many other countries is a lot of our executive compensation. One is we're very wealth concentrated compared to most, say, European countries or compared to Japan. So a lot of our wealth is in the top 5%, 1%, 0.1%. And a lot of their compensation is tied to equity, which means when equity prices are higher, they have more compensation, which they can spend into the economy. And so you actually get a situation where and then they pay taxes on that. So, for example, lower stock prices tend to result in lower tax revenue or a decline in the rate of change of tax revenue, which results in even larger deficits. So I think if they were to try austerity, which yeah, good luck getting that through any sort of political will. But if they were to try that, you probably would have a scenario where, say, they cut spending, but then also revenue kind of stagnates as well, so the deficits stay just as big or or larger. So I think it would take a pretty miraculous change to get off of this course. I've been the meme I've been doing a lot on social media is Walter White. Nothing stops this train, because it's so solidly kind of in action, that until I see something absolutely enormous change its course, I think that's the structural direction it's on. That doesn't mean that any given quarter, any given year, you could have fluctuations, cycles within that trend, but that is the long-term story. And then the secondary question is to determine to what extent all of that debasement, all of that kind of physical dominance, either flows into CPI, likely due to things like energy shortages, or if it flows into asset prices, which is generally what is likely to happen if you don't get energy shortages and or you get a lot of like AI tech deflation and that kind of thing.
In this next segment, Lynn Alden, key challenges facing the US economy are brought to light. Alden discusses the persistent deficit, emphasizing the need for changes in monetary policy to address the issue effectively. Additionally, she highlights the risks posed by higher energy prices and inflationary pressures, which could further strain the economy. Alden suggests a barbell approach, advocating for investments in assets that can hedge against both tech-driven deflation and potential stagflation. Furthermore, she provides a global perspective, discussing currency crises in developing countries and the potential role of cryptocurrencies in addressing monetary inefficiencies.
And that's why I think energy is a very useful hedge because it's one and higher energy prices is one of the major risk factors for non-energy equities. And so in this type of environment, sometimes energy equities or energy things like that can be a better protection against your other equities than long duration bonds can be. So in 40 years, generally stocks and bonds were inversely correlated, but during periods of say higher average inflation, things like energy stocks tend to be a better hedge for those other assets that generally prefer, you know, tech-driven disinflation. Like high multiple growth equities, for example, they generally prefer low CPI, low interest rates, everything's rosy. That's how, and like large deficits because then they can keep just grinding higher. But if that does show up in higher energy prices, higher CPI, that requires the Fed to try to be tighter. That results in more political polarization, more risks for kind of issues. And so I like that barbell approach of some assets very much benefit from tech deflation and just overall currency debasement, and then other ones that are generally benefit more from that stagflationary type of environment. So energy price disruptions or growth against insufficient capex and things like that. I think there's two sides. Like there's two different areas. So in developed countries, like we've just been talking about, it's primarily a question of debt debasement, where the money goes. And if you look at the other side, which is like developing countries, they often have a lot more extreme events. I mean, I spend part of each year in Egypt, and they're currently experiencing a currency crisis. And so they have over 30% inflation. Their currency has lost a tremendous amount of value compared to the dollar, even as the dollar itself has been debased. And that's happening in dozens of countries around the world. And so the a big theme that I cover in Broken Money is that this was largely a technological phenomenon. So ever since, if you go back to kind of the full history of banking, mostly what you're trying to do is make money more efficient. So gold is costly to move around, it's costly to verify, it's slow, and so most of the history of banking was how can we move this faster by moving it as little as possible. So for example, you deposit gold in a third party, and then if me and you are both using the same party, and I want to send money to you or you want to send money to me, we just contact that third party and say debit from this account, add to this account. And that just represents our claims of that gold moving, and that trusted third party just keeps holding the gold. That way, the gold has to move and get verified less often. That's kind of the multi-century history of banking for the most part. And whenever that kind of blows up, you add another layer of centralization. You kind of just built centralization on top of centralization on top of centralization. And what really kind of kicked it into high gear was the introduction of the telegraph. And so that was invented in the 1830s, but it wasn't really widely deployed until the 1860s. So cross continent, cross Atlantic Ocean, connecting the Western world. By the early 19th century, it crossed the Pacific. It kind of connected the rest of the world over time. And by that point, we could move transactions at the speed of light around the world, but of course, we still couldn't move the physical settlement. And so over time, this fractured into increasingly centralized systems. They dropped gold backing entirely, and there's not really been a viable alternative for that time. And so we kind of find ourselves in a world where there's 160 different fiat currencies or so. Most of them rapidly lose value. A handful of the best ones lose value slowly. Most of the other ones are not wanted anywhere outside of their jurisdiction, right? So, for example, I have Egyptian pounds and Norwegian kroner in the drawer next to me, and there's very little way to spend them here in New Jersey. There's even converting them to other assets. There's very little uh, liquidity for that. They basically lose all of their monetary properties outside of their jurisdiction in a similar way that arcade tokens or casino chips lose value outside of their very narrow defined, kind of issuer regions. Um, and there's only a handful of kind of global assets that connect that all together. And so one of the contentions I make in the book is that, even though the broader crypto space has been filled with hype and fraud and scams and things like that, that Bitcoin and some of the underlying technology and things like stable coins are actually powerful innovations that are solving problems and that are probably going to surprise a lot of people to the upside in the years ahead in terms of what their staying power is like and what they end up changing.
In today's analysis, we delved into the intricacies of the US economy and global financial trends with insights from Lynn Alden. From the persistent deficit to the challenges posed by energy prices and inflationary pressures, Alden's expertise shed light on crucial factors shaping our economic landscape. As we navigate through these complexities, consider subscribing to stay informed about the latest developments. Don't forget to like this video and share your thoughts in the comments below. Thank you for watching, and we'll see you in the next one.